When your investments perform well, that growth feels great, until you realize how expensive selling can be. Between federal capital gains taxes that can reach 20 or even 23.8%, plus state taxes, it's not uncommon to lose a quarter of your profits to taxes. That's why many investors, especially those with highly appreciated stock, real estate, or business holdings, use a smarter approach, borrowing instead of selling. When you borrow against an appreciated asset, the money you receive isn't considered income. It's loan proceeds, which means it's tax-free. So rather than selling an investment and realizing a taxable gain, you can unlock liquidity while keeping your portfolio fully invested and compounding. Let's say you own a stock that's doubled in value. Selling it triggers taxes. But if you borrow against that position using it as collateral, you can access the same amount of cash without realizing a gain. Let's say you own a stock that's doubled in value. Selling it triggers taxes. But if you borrow against that position using it as collateral, you can often access cash without realizing it as a gain. You maintain ownership, stay exposed to future growth, and defer taxes indefinitely. If you hold those assets until you're passing, your heirs could receive a step up in cost basis, wiping out the unrealized capital gains entirely. If you hold those assets until you're passing, your heirs could receive a step up in cost basis, wiping out the unrealized gains entirely. That's part of what's known as the buy, borrow, die strategy, the long-term wealth management framework used to keep assets compounding tax efficiently over time. With securities-backed lending, most custodians and private banks offer lines of credit backed by your investment portfolio. Typical loan-to-value ratios range from 50 to 70%, and rates usually have lower than unsecured borrowing because the assets themselves serve as collateral. It's a flexible, efficient way to raise cash while keeping your investments intact. The strategy isn't without trade-offs. There are interest costs. As interest rates rise, so do borrowing costs. There's leverage risk. You don't want to borrow more than you should in case assets go down in value, and thus you would have to add more collateral or repayment. And third, non-deductible interest. So most personal loans, including most portfolio-backed loans, don't generate deductible interest. It's crucial to align borrowing with a thoughtful plan, not to finance lifestyle inflation, but to enhance flexibility and long-term growth potential. Borrowing against appreciated assets can be one of the most tax-efficient tools for managing liquidity and preserving long-term wealth. It keeps your investment working, allows compounding to continue, and can integrate seamlessly with estate planning strategies designed to minimize capital gains taxes altogether. Used wisely, it's not about avoiding taxes forever. It's about timing them strategically and letting your wealth grow uninterrupted.